companies that excel in both workforce and environmental practices outperform the Russell 1000 by 21.7% from January 2018 to July 2023. And in that same period, companies leading on all just capital metrics delivered an outstanding 66.6% total outperformance compared to their lower ranked peers. All right, thank you for tuning into the NAGOMI podcast. Today, I'm your host, Sean Obana, and today we're going to dive into where purpose meets performance. We're going to dive into shared value and social purpose investing, not as a philanthropy and not as branding fluff, but a neuroscience-backed and psychologically grounded strategy for real economic growth and performance. We're going to explore how our brains, values, and real-world data show that social impact and profitability aren't opposites but powerful allies. So firstly, why purpose feels right and why does it work, right? Well, neuroscience shows that purpose activates the brain's reward circuitry. When individuals perceive their work as meaningful, there's an increased activity in the ventral striatum and the prefrontal cortex areas associated with motivation and decision making. And this is from Roy F. Baumeister, an American social psychologist, in 2013. The social identity theory by Tajfel and Turner in 1979 demonstrates that people strongly identify with organizations whose values reflect their own, boosting loyalty and performance. And a Harvard Business Review study found that employees who derive meaning from their work are 3 times more likely to stay and 1.7 times more likely to be satisfied. And that was a study in 2018. And why does this matter? Well, companies with strong social missions see lower turnover, higher innovation, and greater productivity. It's a biological and behavioral return on investment. And so the business case. Well, shared value drives profit, and it's not often seen that way. It's often seen as, oh, well, you're just having this great CSR corporate responsibility because you just want to look good in the eyes of others, right? But there's actually a case where it's actually profitable and it's proven. We just haven't been able to quantify all of this qualitative data, this qualitative benefits that we receive based on these shared value companies. And this is all based on this new data is based on another Harvard Business Review. So Nestle's Nespresso rebuilt its supply chain by supporting small holder coffee farms. They trained farmers, financed equipment, and improved yield, tripling farmer income and securing Nestle's premium coffee supply. Nespresso has grown 30% annually since 2000. Johnson & Johnson's wellness program saved the company $250 million in health costs and returned $2.71 for every dollar spent through reduced absenteeism and higher productivity. And lastly, Walmart cut 100 million delivery miles and saved $200 million while reducing carbon emissions, proving sustainability is not a cost, but an opportunity. So shared value means expanding the pie, not dividing it, right? And it's not charity, it's just smarter capitalism. So what is shared value investing? So let's go through some definitions here. Shared value investing is investing in companies that proactively create economic value by solving social problems. Social purpose investing is investing in based on companies' alignment with a clear, authentic societal mission, often with long-term outcomes in mind. Why is this important? Well, individual behavior affects group behavior, which affects systematic and global behavior. So I think what the shift that's happening now is that people are starting to see the value, the real value, the economic value, the societal value, the shared value of shared value in organizations, and we're just being able to quantify all of this qualitative data and benefits to our lives and to everybody else's lives. It's that, 1 + 1 = 3, right? And it'll start slow because it starts with some disruption of individual behavior, but it'll eventually expand into globally, right? We can't just snap our fingers and say, this is just how it is. This is how it should be because of all of this, right? It takes some time. So what we're going to see over time is it's going to start with some individual businesses. It's going to grow into a group, a certain industry of businesses, and then it's going to grow systematically. So, a framework according to Porter and Kramer in 2011, the 3 ways to create shared values: reconceiving products, markets to meet underserved societal needs; 2, redefining productivity in the value chain, whether it's energy, logistics; and 3, enabling local clustering development to boost regional economies. So this is on the topic of agglomeration economies, right? And thing like that. So we can think of these aren't just cost centers; they're actually innovation hubs, right? And they're engines of growth when seen through the right lens. Let's get into now the more psychological and neurological aspect, because now we've proven that, this has benefited many American companies, like I explained before in the Harvard Business Review. And then second, I explained some ways that, companies and people can start exercising shared value or adopting shared value, right? And now we're going to get into the behavioral biases that block shared value. So even though we know that this is such a great thing and it's helping our society, it's helping companies' profits, it's helping not only it's shareholders, like stakeholders, all stakeholders, whether it's customers, the clients, the employees, etc., right? But what are these cognitive biases that are getting in the way of this, right? We think of short-termism bias. This one isn't often talked about, but for example, McKinsey's study in 2017 showed that CEOs focused on quarterly earnings due to market pressure, despite evidence that long-term oriented firms outperform on revenue and earnings growth. So it's highlighting the effect of what the consequences of thinking in the short term due to the benefits of thinking in the long term. There's so many benefits in the long term, right? You see that the stock market over any 20-year period is positive. I think in a 10-year period, there are some negative spots, right? But over a long-term period, right? 20 years, it's always positive, right? And I'm not saying that you can invest in any stock or any market and you will be positive over the next 20 years, because we don't know that yet. But I'm just saying, looking at history, right, based on the companies, we hope that companies will keep getting better and improving their earnings, right, over time. So that's where we see the real return. And the second bias is loss aversion. We talk about this many times. But an example from Kahneman and Tversky in 1979, these are two of the most influential psychologists known for founding the field of behavioral economics, founding it. And Kahneman wrote Thinking Fast and Slow. You might have heard that book. But basically, what they've found is that managers fear costly social investment, even though data shows it increases efficiency. This is a classic status quo bias as well. And lastly, the confirmation bias. Investors undervalue purpose-led firms due to outdated mental models of CSR as mere charity, right? Okay, it's this confirmation bias saying that, anybody who adopts these CSR principles or whatever is only doing it for charity. It's only doing it for show. It's only doing it to say that they do something to look for their branding, right? But that's something to look out for and recognize if that is the reason that people aren't adopting shared value or companies aren't adopting shared value. If that's the real purpose, then that's a huge red flag. That's a huge confirmation bias signal. And so, what are the psychological fixes for this? Well, we can reframe social investments as productivity drivers, right? Instead of saying, oh, well, they're just doing it because they want to look good. It's actually proven that it's going to increase growth. It's going to increase productivity, efficiency, right? It's going to be that 1 + 1 = 3. And another fix is to train the workforce and leaders in systems thinking, empathy, and behavior economic skills proven to improve complex decision making. This specific piece of evidence was from a psychologist, Portuguese neuroscientist who's also professor of psychology, philosophy, and neurology at USC, Antonio Damasio. And lastly, we'll get into the real world ROI, real world return on investment, that shows that evidence that purpose-led firms win. So Just Capital is a nonprofit organization that ranks U.S. companies on how justly they serve all their stakeholders, right? So not just their shareholders, but workers, customers, communities, environment, and shareholders collectively. And they did a study in 2013 that found that companies that excel in both workforce and environmental practices outperform the Russell 1000 by 21.7% from January 2018 to July 2023. And in that same period, companies leading on all Just Capital metrics delivered an outstanding 66.6% total outperformance compared to their lower ranked peers. And I want to highlight that the Russell 1000 are small cap stocks, right? So it's not the S&P 500, just to make that clear. Another piece of evidence is that the Financial Times reported a study by Alex Edmonds from LSE, London School of Economics, that found that companies with high employee satisfaction outperformed peers by up to 3.8% a year in investment returns, not straight revenue, just the investment returns, right? And in the FTSE, the Financial Times Stock Exchange, firms with strong CSR delivered 3.3 to 7.7% higher total shareholder returns annually and recovered faster during downturns. Lastly, BlackRock CEO Larry Fink noted in his 2022 letter that stakeholder capitalism is not woke, but rather capitalism driven by mutually beneficial relationships between you and the employees, customers, suppliers, and communities your companies rely on. So the bottom line is that purpose isn't just a PR strategy, it's a growth strategy. And in conclusion, shared value isn't just this checkbox that companies and people should be looking to check off, right, for that PR rep, but it's the next evolution of capitalism, the strategic edge that helps companies grow while also solving real-world problems. Invest in purpose not because it's nice, but because it works, because there's data backing it, because there's data and neuroscience and psychology and all of this, right, backing it, and also saying why we aren't doing it. So thank you for tuning into the NAGOMI podcast, and I hope this was helpful.